Ethereum sitting deep off highs while Bitcoin bleeds slowly is exactly the environment where positioning is decided, not celebrated. When everyone feels confident, the upside is already priced in. When events are happening and uncertainty dominates, that is when long-term capital steps in. Three catalysts converging into a single week is not noise, it is compression. Rate decisions, Fed language, and global positioning are colliding at the same time, and that collision tends to resolve with force. This is not about calling a one-day candle. This is about recognizing when the risk-reward flips quietly while most people are emotionally frozen, waiting for confirmation that only appears after price has already moved. Bitcoin being down nearly 30% and Ethereum down over a third from recent highs is not a sign of failure. It is a reset of expectations. Markets do this to shake out weak positioning before larger moves. What makes this moment unique is the internal fracture at the Federal Reserve. This is the most dissent Powell has faced in nearly a decade, and dissent matters more than the headline rate cut itself. A 25 basis point cut with disagreement on both sides sends a different signal than a unanimous decision. It tells you policy confidence is thinning. Markets do not need perfection, but they react aggressively when certainty cracks. A hawkish cut paired with internal disagreement is fuel, not relief. And crypto has historically responded to that kind of tension with volatility first and trend second. History has been almost cruelly consistent around FOMC meetings this year. Bitcoin runs into the meeting, chops around, then sells off after the fact. September did it, October did it. The pattern is obvious enough that complacency sets in, and that is when patterns break or accelerate. When something becomes consensus, it loses its edge. The market already believes in a 25 basis point cut. 94% odds means surprise risk is asymmetric. The reaction will not be about the cut itself, but about tone, dissent, and forward guidance. That is where the real signal hides, and that is why price action around this meeting matters more than most people realize. The leadership transition at the Fed adds another layer entirely. Powell on his way out and a pro-growth replacement on deck changes how every word is interpreted. Even before the official handoff, markets begin pricing the future regime. Statements lose power when authority is temporary. If the next chair is more growth-oriented, markets will start pulling liquidity expectations forward. That does not mean straight up, it means repricing. Crypto thrives in repricing environments because it trades expectations faster than traditional assets. That is why short-term uncertainty does not invalidate long-term bullish structure. It reinforces it. Globally, the narrative is shifting even faster. Bitcoin is no longer treated as a speculative experiment by every nation. When countries like the UAE openly frame Bitcoin as a strategic financial asset, that is not marketing, it is signaling. Strategic assets are accumulated quietly, integrated slowly, and defended fiercely. Mining being described as the heartbeat of the network by sovereign voices matters because it frames Bitcoin as infrastructure, not trade. Infrastructure assets behave differently. They are volatile early and stubborn later. This shift in framing is happening while price is suppressed, which is exactly how long-term trends usually begin. Supply dynamics continue to reinforce this structure. Hundreds of thousands of Bitcoin leaving exchanges over the last year is not coincidence. Coins do not leave exchanges unless holders intend to sit through volatility. Reduced exchange supply historically limits violent downside because forced sellers dry up faster. This matters for Ethereum as well, because Ethereum's fate is increasingly tied to real settlement demand rather than speculation alone. Ethereum has quietly become the dominant chain for tokenized assets, and Wall Street follows functionality, not narratives. Ethereum settling more dollar-denominated value than Visa and MasterCard combined in a single quarter is not a headline built for hype. It is a structural milestone. Stablecoins do not care about market sentiment. They move when people need them. Nearly $6 trillion in on-chain stablecoin volume signals something profound. The on-chain economy is no longer theoretical. It is operational. Ethereum being the primary settlement layer for digital dollars means it sits underneath future financial flows, whether traders like it or not. That kind of positioning rarely gets cheaper once adoption locks in. The unresolved issue is privacy, and this is where the next narrative rotation is forming. Bitcoin and Ethereum solve settlement and security, but transparency becomes a liability at scale. Financial systems require confidentiality. That is not optional. Industry voices increasingly point to 2026 as the year privacy stops being niche and becomes necessary. The explosive move in privacy-focused assets recently was not random. It was an early signal that markets are front-running that realization. Zero-knowledge proofs and confidential layers are no longer academic. They are becoming infrastructure components. Bridging privacy without sacrificing custody or liquidity is the missing piece institutions care about. Assets that can gain confidentiality while remaining compliant unlock entirely new use cases. This is why privacy is not a contradiction to regulation, it is a complement to it. Regulated systems still require discretion. As this layer matures, capital flows will follow functionality, not ideology. That transition tends to happen fast once it starts. Regulatory pressure easing elsewhere reinforces this backdrop. Investigations closing, pilots launching, and collateral frameworks expanding all point in one direction. Crypto assets are being absorbed into traditional financial plumbing. Allowing Bitcoin, Ethereum, and stablecoins as collateral in derivatives markets is not symbolic. It directly increases demand elasticity. Assets that can be posted as collateral gain utility beyond price appreciation. That changes how institutions allocate and manage risk. Even traditional media voices are quietly shifting tone. When commentators openly state that buying Ethereum during drawdowns makes sense, that reflects a change in mindset. Balance sheet clarity is becoming more important than leverage theatrics. Clean exposure to underlying assets is favored over financial engineering when volatility rises. That preference aligns with long-term accumulation phases, not late-cycle euphoria. Everything circles back to liquidity. Liquidity is the lifeblood of markets, and liquidity cycles are turning again. Quantitative tightening has effectively ended, even if the language avoids saying so. Massive debt buybacks beginning next year inject support, whether policymakers admit it or not. Liquidity does not ask permission, it flows where returns exist. Crypto remains one of the most sensitive receivers of marginal liquidity, especially when narratives align with structural adoption. This is why weeks like this matter more than green days. When fear dominates headlines and catalysts stack up quietly, positioning happens beneath the surface. By the time confidence returns, price will have already adjusted. This is not about predicting tomorrow. It is about understanding phase shifts. Crypto moves in phases, not straight lines. Phases begin in discomfort and end in disbelief. The long game is being decided while attention is elsewhere. Infrastructure adoption, regulatory normalization, liquidity inflection, and narrative rotation are converging. That convergence rarely happens loudly. It builds pressure until release. Whether volatility comes first or trend follows immediately is secondary. The larger move is being prepared regardless. Those who understand that do not need certainty. They need patience and positioning.